please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
And the first trade is only 0.2 higher on the Nifty and 0.3 higher on the Nifty Bank. So Nifty Bank didn't open at 0.5% higher as was indicated, unless someone sold very quickly. Now it's flat. Red actually. Nifty Bank is in the red. The Nifty itself is now, mid-caps have also gotten into the red, and the Nifty and the Sensex are just about holding in flat terrain. Now the Sensex has started flirting with the red. So very flat opening at the Nifty level, and the stocks that are doing well are Indiabulls Housing, of course, up 2% after those numbers, but HPBP, so, you know, probably as Mr. Tulsian said, people have thought that there is enough selling, or that prices are getting passed on at the moment. We are still at the highest ever petrol prices, so probably the stock is not getting punished at this point in time. TCS about 1% higher. IOC also is with HP and BP about 0.9 higher. Reliance is higher. L&T 0.7. Titan, ONGC, of course, because of the crude rise. Z Entertainment, Kotak Mahindra Bank, HDFC. Kotak and HDFC Bank are just about 0.5% higher. So not good enough to counter the 2% fall in ICICI. That's the biggest loser. Followed by Infosys, 1.6 down. Bajaj Finance, 0.8 down. Then come Hero Motors, Cipla, Bharti Airtel. Even Axis and SBI, both lower by about 1/3 to 0.5%. So in short, it's very flat for the Nifty. ICICI Bank, take it away what HDFC and Kotak give.
Absolutely flat for the mid-caps as well, so not moving at all. The frontliners in the mid-cap space, okay. The market breadth is now at 1:1 in favor of the advances, so marginal bit of green hue there. Unichem Labs is actually the stock of the moment, 8% higher on Unichem Labs. Volumes are picking up. As we told you, zero observations at the Ghaziabad plant. Sasken Technology came out with a good set of numbers. On the operational front, the margins actually improved for the company to almost 16.5%, so that stock is now up almost 4.5%. Phoenix Mills has inked a deal, a land deal, so that one is in the green, up almost about 2.5 to 3% Couple of these stocks in the metal space have bounced back, the likes of Nalco, etc. But otherwise, it's absolutely flat for the markets now. Of course, result reactions, Indiabulls, etc. are doing well. On the downside, Bhushan Steel is down about 5.5%. Alok Industries, Lanco Infratech, all your penny stocks, Castex are under pressure. ICICI Bank, by the way, is down 2% this morning, just an opening tick, so keep an eye out on that. It has other PSU banks for company, Canara Bank, Union, Bank of India are all under pressure. So banks really are dragging the market.
Yes, banks are dragging the market, and now in fact the bank Nifty is already making the lows of the morning, which is quite interesting. You know, IT is trying to fight back, but of course, for now, you know, now 10,556 on the Nifty, so now getting towards what that SGX was indicating, perhaps, but for the futures, on the spot, 10,554 is what we have. Ashwini, you're going short on the bank Nifty, or is there a different trade now?
See, I told you at the open you should go short. The bank Nifty futures bar is 300 points long. It's been 4 minutes since the market has opened. So I think today you are going to break the previous 2-week low, which is 24,860, and possibly you have a 400-500 point downside. So today looks like a bad day for the bank Nifty. I think HDFC Bank is already in the red. So the PSU banks and NBFCs will have a bad day. IT may try to fight back, but today, you know, banks are overwhelming the rest of the market.
Okay. Sudarshan, anything that you're spotting?
Well, yes, the trade is to go short in the Nifty, buy 10,550 puts for the next 3 or 4 days of settlement. Broadly, that's the view. I don't think too much buying should be done.
Okay. Ashwini, thoughts on Canara Bank? That's opening almost 3% lower right now.
See, this was the 914 call, and clear downtrend has started. PSU banks had a mild rally, but now I think their downsides have started. See, the entire, you know, inflation getting mellow, etc. That trade is out, and that was probably a 1,000-point trade. So that's the problem Bank Nifty has now, that the entire upside 700 points we went up the day of the policy. All that will, you know, more or less get taken back.
Okay. Gentlemen, thank you very much for being with us through the morning trade and giving us your early morning trades. Then, you know, if you can continue that conversation you were when you spoke about the global triad of high dollar, high crude, and high yields. You know, last time around in 2003, we could take advantage because we also had lower yields in India and a current account deficit that was not so daunting. Now it looks like both those are not with us. The bond market is totally broken, almost 7.7, 7.72 now on the yields. Will we therefore negotiate this global problem with some difficulty?
It won't be easy, Lata, as you say, and that's the point I was making earlier, that is the crux of the matter at this point. You know, you've got 2.96% out there, and 3% is psychologically such an important level in the US on the 10-year yield that if that breaks, you might have some kind of a sentimental reset going on there because the penny will finally drop on the fact that you've got almost an inverted yield curve out there in the US, which a lot of people have started talking about. Closer home, you got that feeling after the policy that maybe bond yields have reversed and in the near term will not take out their recent high. But I think we're just about 6 basis points away from that old high now. And all that sentimental uplift that we got on the feeling that our bond yields have now tempered down has sort of got washed away. The rupee's at 66 plus already, with every possibility the way crude is going and the current account deficit is of slipping further. So, you know, these macros are not sitting very well. And it comes as a critical juncture when the Nifty is trying to negotiate an important level of 10,600. So let's see how the cookie crumbles. But I think the headwinds have picked up in the last 7 or 8 days, no question about that.
Okay, for now the market is absolutely flat, so not moving much either way, even on the mid-cap. So Udayan, before we let you go, it was quite a bittersweet weekend, right, for all the fans. I mean, after 21 years, finally Wenger is out. You think the prospects of the team would improve now?
Yeah, one can only hope, Sonia. I mean, he had a great career, and I think we should remember it well and wish him well on the journey, because it'll be harsh to say that thank God Wenger is gone. I mean, that's what a lot of people are probably saying at Arsenal, but you know, he did great things for us, maybe not in the last few years. So farewell to him. Let's see who we get. Fingers crossed on that.
Oh yes,
you know, I like that.
Late 90s and early 2000s, when, you know, it was all about Manchester United and Arsenal. And one good thing about Arsene Wenger, those were the years in which Premiership was won by growing in-house talent and not by, you know, money power. Last 5 or 6 years, it's been all about money power. And Udayan would agree that, you know, the golden era of Arsenal, 2003-04, the Invincibles, right, Udayan? I mean, what a team that was.
Yeah, it was, and I take your point about homegrown talent. And on a much smaller scale, you know, CNBC has been like that. We've always resisted getting people from outside, and our homegrown talent keeps us at #1. We are not quite at that level, but, you know, we continue to be #1 with homegrown talent. Kudos to all of you.
That's a kind thought.
But Udayan, I must say, Wenger's legacy has been untouched, very similar to yours. So that's the only way I'd like to put it. But yeah, as you rightly said, I mean,
no, Udayan is not going away.
Not gone anywhere.
Okay, thanks, Udayan, before this gets emotional.
Is that a hint? I take it. Is that a hint?
No, it's not. That's why I'm correcting her. Okay. Thanks, Udayan. Thanks for joining us. And we will keep dragging you in oftener than you would like, perhaps. But no, you're not going anywhere. Thank you very much for coming in today. Okay, Ashwini, I think we didn't ask him the big call for the morning. Ashwini? Ashwini, can you hear me? Okay, I think, he must have disconnected. We'll get back to Ashwini in just a bit. But the scene on the indices is very, very difficult to decode at this point in time. Flat on the Sensex, flat on the Nifty, 1/4% lower on the Nifty Bank as expected, and flat on mid-caps as well.
Flat on mid-caps as well. The space of the moment, I mean, apart from mid-cap IT, NIT Tech, Mindtree, just phenomenal moves in both these names. Just keep an eye on both HPCL and BPCL, because you know, even if that report is not right, which is that excise duty might be cut, if you take a look at today's petrol price and diesel price as well, today also the petrol and diesel prices have been hiked. So you know, the marketing margins have not been impacted as much as, you know, you thought they would be. In fact, they've been able to raise prices all through the last 15 or 16 days, and that's holding them in good stead. Let's invite our market master for the day. Then Deepan Sheth is with us from HDFC Securities. Deepan, good morning. Let's start with some of these spaces which have been quite active of late. Let's start with IT actually. Your thoughts on the phenomenal surge that we have seen?
So some of that has obviously got to do with the fact that Indian IT reinvented itself over most of FY18, even as the big doubts and the big clouds were looming on the horizon. Whether it was, automation, whether it was cloud apps, whether it was the entire digital part of their business mix, which people were skeptical on, whether it was boardroom wranglings, let's say at Infosys, for example, and all of that combined to make people, or to give people a little bit of disillusionment on IT. We called Indian IT services pretty early in the game, and we were panned for it. So we go right, we go wrong, but this time we went terribly right. Let me get just a few grams of credit for that. And I've been saying this, and you can go back to all your earlier videos. So we've been saying that here is an industry which is run by possibly the most talented set of people in the country, some of the cleanest promoters, some of the cleanest cash flows. And when you see valuations at 11, 12x, you don't really worry about whether there's a structural meltdown, especially if the evidence which is coming in is that they are working harder by the minute to reinvent themselves. And somewhere you need to take a faith-based call. So whether it was an Infosys, whether it was an Infosys, whether it was a Mindtree, these are all stock upgrades and initiations and recommendations that worked for us. Now, right now, if many of these stocks are 20, 30, 40, and even 50% up. The L&T twins, for example, on maybe a 14-15 month period, or maybe about a year's period, they've almost doubled, if you can look at it that way. So what do you do now that you've made the big money? So here is the tide coming in now for them, not just their own internal reinvention. The tide is the dollar. The tide is the structural weakness and the Achilles heel that India has in the face of rising commodities. And quite frankly, I don't see any reason to book profits in IT right now, and that is what is happening. The latecomers are hitting the buy buttons, but the early investors are not yet selling. So you will still see a lot of buoyancy in IT. In fact, if I may say so, it's the large caps which should now sustainably outperform. Okay. We've gone doggedly wrong, just like we've gone right on the sector broadly, but we've gone doggedly wrong on TCS, where we thought valuations were enough. But you know what's going to happen here is that, so look at the multiple we are giving Mindtree. Target multiple for Mindtree is 20x, because you're getting 30% earnings CAGR for 2 years, and the kind of growth visibility that is there. So and TCS, we are still at 19. Now, if we were to revisit this assumption, what would happen? If we were to upgrade Infi by a couple of notches, and remember, these companies spew out billions of dollars of cash every year. They don't have a big need for capital, and the tailwind of a soft rupee and a hard dollar, if it hits them, what can it do to margins?
Okay, so that's on IT. Morning, Deepan. I wanted to talk a little bit about banks, because, IndusInd Bank is a stock you've liked for a very long time. Yes. But this time around, we saw some negatives, right? The divergence, etc. Would that be a niggling worry, or do you think that it doesn't matter because the prospects are strong? So
let's look at IndusInd Bank through two lenses. One lens is the lens of absolute goodness, and the other lens is the lens of relative goodness. So on absolute goodness, everything has gone right for a number of, so right up to the second phase of their, build out, as they call it. And nothing has gone wrong, if I can say so, in the last 6 or 7 years at IndusInd. They've got a reasonably well diversified set of credit exposures, which kind of hedges them for the longer term. They are very good at lending. If I can put it in one simple sentence, they do not have an asset quality issue at all, unlike many of even the private sector banks which have gone through that kind of hurdle. Growth is not a challenge given their relatively smaller base versus, let's say, an Axis or an ICICI Bank. They've never been challenged in terms of their operating metrics and their very, very fat fee income streams, which many other banks, many more large and respectable banks, are actually jealous of. Now, what has gone wrong? So if you look at this absolute goodness, what is it apparently got marred by? And that's the question of the divergence in asset quality, which has been reported for their
also
their
doubling
FY
of slippages.
Right.
From 400 it became 800 crore.
Right. So I think the slippages reporting bit is not such a big worry now. If you look at it in absolute terms, maybe it does. But if you look at it in relative terms and what percentage it corresponds to, I don't think that's a big worry. The big 1,300, 1,400 crore difference that people were talking about on the divergence is also not a worry. Let me argue this through. Because a lot of those accounts were technically should have, according to the RBI, been classified as NPAs, but then subsequent behavior vindicated IndusInd Bank's stand. And here is one, and there's one more instance of a large account there, where apparently the RBI has said you need to classify this as an NPA on judgmental grounds and not on credit behavior grounds. So if the account is not really 90 days past due, why on earth should IndusInd provide against it or recognize it as an NPA? So if you strip off these, these disputable classifications, the net divergence doesn't really look very material to us. So it's not a reason why we should downgrade earnings. It's not a reason why we should downgrade multiples.
Okay. What about other NBFCs? Anything that you like in the pack despite the rising yields?
So, frankly, I think on the NBFCs, we should see a little bit of easing off. So again, this is an old call. For example, I've been talking about, let's say, something like a Chola, right? Yes. And now you're close to something like 4 times book on F20 basis or thereabouts. I mean, you can do the exact arithmetic. But so maybe I can't justify that you should buy it at this valuation, but can I fish for a reason for you to sell it? I said this, I think 2 weeks ago on your channel, that I can't think for a reason why a fund manager would want to sell this stock. Just because something gets into a high valuation doesn't mean you sell it. And you can see it happening in the market out there. There's such a big divergence of valuation across, quality and lack of quality, that you don't sell something just because it looks a little overpriced for now. Remember, these businesses are compounding at 18-19% ROE. A bank like DCB, for example, is now at more than 2x on F20 basis. A bank like City Union Bank will continue to compound at 18-20% and a little faster, given the fact that a lot of PSUs are now receding from southern India in terms of their credit hungriness. So I don't think these stories need to be sold into just because they've hit a certain valuation barrier.
Okay, by the way, the stock of the moment now is Sasken. It's up 11% and it has hit a new high, new 52-week high. So, you're making that point about mid-cap versus large-cap IT. Right. I mean, look at Sasken's numbers and the stock movement. NIT Tech as well has hit a new high, by the way. It's up about 4% today. So, are we looking at a better value accretion in mid-caps versus large-caps now in IT? And do you like any of these names like Sasken, etc.?
So frankly, the L&T twins, for example, L&T Tech and L&T Infotech, then to some extent a persistent, where I think we've been persistent, if I may say so, on our constructive view, and some of that is yet to deliver, or whether it's a Mindtree where we took a faith-based call at a certain point of time, or a Scient where we found valuations attractive enough to upgrade and persist with a buy. So I do feel that there is some space in the mid-cap pack to still make money, but frankly the earnings upgrades and in fact the multiple upgrades are more likely to happen in the large caps. That said, if you ask me for 2 mid-cap names, as it were, then we would still repose faith in Scient, and Zensar I think would be among the cheapest of the mid-caps right now at about 12x. I think there are some moving parts in Zensar that people don't really understand, and even we don't so clearly, but I think if some of that clarity comes through, then Zensar could be a very, very decent trade here on.
Okay, there's a lot of stocks are doing well right now. Of course, the Nifty is down about 5 points of flat, but individual stocks, of course, IT takes the cake, but others also, oil marketing companies doing well, IndusInd Bank and Bharat Financial doing well, Adani doing well, a lot of NBFCs as well. Cement has been, making a bit of a comeback, especially the large cap cement. Your thoughts on this whole Ultratech, Dalmia Cement, and how to approach this particular space?
So really, it's difficult to comment on a particular transaction and as to where it might ultimately go, because as we know, a lot of sensible and irrational behavior can happen around large corporate transactions. I don't think the Ultratech people are silly enough to take, stupid decisions, or that they cannot take measured decisions. But, in the heat of the moment, a bid may go this way or that way. And we've seen that happening in the past for Indian companies bidding overseas, for example. So that's one bit. The second bit is that there is persistently high coal prices that cement companies must contend with. And, cement consumption will come off the low demonet / GST hassle-related base. But right now, I do not think cement offers the kind of investing opportunity that it did, let's say, 3 years ago. if I can paint a broad picture there. There will always be mid-caps which will trade at valuations which will look attractive, but you need to be very, very sure that their EBITDAs per ton are sustainable, and that much of the EBITDAs per ton which are being reported are really happening in the form of cash flows, clean cash flows. So some of these companies are reporting higher profits if you look at EBITDAs per ton on the basis of incentives that they are supposed to get back. It's very important to see whether some of those incentives are really being received from the government, or are they just building up as receivables on the balance sheet.
All right, we leave it at that. Be pain safe. Thank you very much for joining us with your thoughts this morning. Okay, let's get to individual corporates now. There was news over the weekend that Phoenix Mills and Canada Pension Plan Investment Board joint venture has invested 650 crore rupees in land for retail development in Bangalore. Shishir Srivastava, the executive director at Phoenix Mills, joins us now to tell us more about this purchase. Good morning, Shishir. Thanks much. Can you, I mean, I would assume it's a 50-50 contribution from both of you. What kind of an ROI are you expecting? I believe that's a catchment area for a great deal of footfalls if you were to put a mall.
Morning, Lata. Yes, thank you very much. You're right. I think this is a grossly underserved part of Bangalore, North Bangalore. With our existing mall in East Bangalore, which caters to the eastern part of the city and the southern part of the city, and now with the proposed development at Hebbal, which will cater to North and Western Bangalore, I think we will have captured the entire market of Bangalore. This acquisition is under the joint venture, under the platform that we have with CPPIB. And you are right, this is a 49-51 platform where CPPIB currently owns 49% of the equity of that company.
Shishir, hi, good morning. Can you give us some more numbers? How many million square feet of retail mall space will you have post this deal? And what is the equity commitment that we are looking at over the next few years?
Currently, we operate a little over 6 million square feet. And with the acquisitions that we have under our belt, under the platform with CPPIB, we are developing rental assets of close to about 5 million square feet under that platform, which includes about 2.35 million square feet of retail, and the balance would be probably offices as part of phase 2. We completed an acquisition in Pune last year, and now with this acquisition at Hebbal, and also we have some balanced development potential at the existing operating assets under the platform, which is in Bangalore East. Between these three, the total development potential of retail is about 2.35. So upon completion of this development, we will be close to about 8.5 million square feet of retail assets under our belt, and an additional commercial development potential of another 3.5 million square feet.
Okay, so sorry. What does how long will it take for this 2.35 million square feet?
So we are currently in the design and development stage, and we should take about, I would think, about 3.5 years to see the first asset operating.
Okay. Shishir, good morning. I wanted to also talk about your Mumbai property, especially Kurla, because you reckon it's been a bit of a disappointment for you over the last 4 or 5 years. I mean, not as much as you would have thought when you first started this?
So I would beg to differ. Yes, there have been challenges, and it's, I would say, when we commenced operations of that asset in November 2011, it did take us about 3 to 4 years to see significant traction there. But the last year has been extremely encouraging and extremely positive for the asset. We genuinely believe that this is Phoenix Market City at Mumbai, at Kurla, is amongst the best assets that we have under our belt. And we expect to see the performance only improve further going ahead from here. So a lot of work has gone into, improving that asset's performance. If you look at the brand mix that is presently there, the experience, the interior upgrades that we have concluded, and which drives the correct profile of customer there and a huge consumption. So we are seeing a very, very positive trend in terms of consumption at that mall, and the trading densities are improving significantly. I think every retailer is extremely happy there, and so are we.
Okay, a Macquarie report says that you all will have created 4 to 5 million square feet of grade A retail mall space over 5 years. That's why I asked you for this 2.35. You said 3.5 years. Over 5 years, is this
yes.
Is this a rate you will be able to reach? 4 to 5 million square feet more?
I think we are well on our way to accomplish that target. There is another mall that is under acquisition at Indore, which will add another 1 million square feet to the portfolio. And we are looking out for another 1 or 2 more opportunities there. So, in fact, I would like to say that while our current goal is to ensure that we are building up around between 4 to 5 million square feet in the next 5 years, we are looking beyond the next 5 years, and we see tremendous opportunity in this country, and we would like to see another 5 million square feet getting added in the next 5 years.
And what would the reasonable realizations
beyond 2023.
Okay. Sure. What would the reasonable realizations be? Because just quoting the same Macquarie report, they say that an FSI price at about 3,800 rupees a square foot appears reasonable to us. Is that something that you would be looking at?
Yes, I think for a retail asset, that's a sustainable price for acquisition. Of about anywhere between 3,000 to 4,000 would fit our projections. And typically one would look at an equity return of anywhere between 22 to 25% over once the asset commences operations. So I would say 5 years of development and 3 years of stabilization. Within that period, one would look at an equity return of anywhere between 22 to 25%.
All right. We will leave it at that, Shishir. It was a pleasure speaking with you. Thank you for filling in us with all those details about the newest deal and, of course, your retail ambitions. Let's now turn our eyes back to results. One of the numbers that came on the weekend, Nifty company, was Indiabulls Housing Finance, and it was a very robust growth in loans of 34.3%. Gagan Banga, Vice Chairman and Managing Director of Indiabulls Housing, joins us now. Good morning, Gagan. Thanks much. Well, can you take us through the quarter that went by? 34 is a mind-boggling pace of growth. Is this maintainable? How does FY19 look?
Yes, good morning, Lata. So we've been guiding for profit growth of between 20 and 25% and loan book growth of around 30%. The last 2 years, we've been managing to grow the book between 30 and 35%. And that's largely because affordability in the housing space from a consumer point of view has been steadily improving. Prices of homes have been flattish. Interest rates have been down, and ever since the subsidy program kicked in, it's been meaningfully cheaper for someone to buy a house as against live in a house. Specifically from Indiabulls Housing point of view, all of our digital initiatives are essentially helping us build a lot of number of loan kind of growth. So that's the whole focus area of the company. It took us about 10 years to get to 1 million customers, and it should take us just about 2.5 years to get the next 1 million customers. And that's largely because of the digital initiatives that we've taken, which have allowed us to engage with relatively smaller borrowers without impacting our cost income. Okay. The other important piece is that the competitive landscape is extremely benign. And a large part of the banking system is caught in its own issues. So between competition, digital and affordability, I think we have a pretty good headroom to grow, and fiscal 19 should be no different. So profit should be compounding at between 20 and 25%, and book should be growing at between 30 and 35%.
Okay. Gagan, good morning. Good numbers from your stable, of course, as always. On a slightly lighter note, there was this WhatsApp video, right? I mean, where you had, an Indiabulls employee quite aggressive, and that was an interesting campaign. You shot it down. What was wrong with that campaign? It was generating quite a bit of, mojo on Twitter and WhatsApp. It looked quite interesting.
Yeah, it's a good thing to know that employees are excited and they're pushing what they're supposed to be doing. So what we've been doing, just to give you a background, is that we've been setting up these kiosks essentially because after the CLSS scheme, the PMAY scheme, it is very, very attractive for the salaried guy to be taking a home loan, and we're trying to do a reach out program to them rather than just wait at either the construction site or in our offices. As part of that, one of our employees choose to be rather adventurous. We strongly believe as a company that home buying is amongst the most significant, if not the most important investment decision most families in India make, and there has to be a certain level of discretion as a lender that we need to exercise. Both we have to focus on servicing them, but we also have to respect that decision, which is why management chose to come down heavy. And while we appreciate the excitement, discretion has to be exercised as well.
How much of your loan book comes from the CLSS affordable housing category, the ones that were subsidized?
Yeah, so about 80% of the loans that we would be doing by number would be qualifying for the subsidy scheme. The subsidy scheme has been massively expanded. It covers now income profiles as high as 18 lakh of rupees. Our average borrower's income profile is about 10 lakh of rupees. And
qualifying,
which is why,
Gagan,
what one has been steadily...
Not qualifying.
Sorry?
How many actually got? Because what we got from the NHB and NHB and Sudhin Choksey gave us a very different impression that they are not getting the money in time from the subsidy, and therefore not many loans have gotten cleared by the for subsidy. Eligibility is one thing. How many got it actually?
Okay, I'm sorry. I think that after the initial teething period, which lasted about till about November, since then the subsidy disbursal has stabilized. Obviously, both at our end as well as the National Housing Bank end, they have to exercise due caution. It is money being put into people's accounts, so the necessary paperwork is checked 2 to 3 times over. But from a logistics point of view or from a money availability point of view, there is no concern. I was rather happy to see that towards the second week of March, there was actually a meeting held with senior officials at the ministry to figure out if there was any problems. And towards the end of March, massive monies were disbursed. So
any of yours?
I don't think there is any...
What percentage of your loans?
There is any issue. About 40% of my borrowers would have gotten the money.
Okay, that number that we were talking about, we did that whole analysis on Friday as well. Gagan, just hold on. TCS has hit $100 billion in market cap. It listed in 2004, if you have those graphics once again, it listed at about $10 billion market cap. According to those rupee rates, 47,000 crores of market cap is where it listed at. And since then, considerably gaining size and gaining market share, and of course now market cap of $100 billion. The point here about TCS, the market cap journey is coming up, of course, on that one. If you compare it, that's of course the 2004 listed at 47,000 crores, immediately went to 1 lakh crores in 2006, then 2 lakh crores was also quite early. After that, a bit of a hiccup, but after that, 2013 was where it hit 3 lakh crores. Then, of course, the next 1 lakh crores was rather easy, 4 lakh crores. Then IT sector went through a bear market, but TCS somehow managed to do well. And from 5 lakh crores to 6 lakh crores, it took time. But from 6 lakh crores to, of course, now 6.6 lakh crores. And just a comparison between TCS and Infosys, it listed at 25% discount to Infosys. And now this is not to say anything uncharitable about Infosys, which actually has been a far more value generator or wealth generator than TCS, because TCS straight away listed at 47,000 crores. Infosys listed at, say, less than 1,000 crores. But it listed at 25% discount. Now it's 2.5 times Infosys, and it's got market cap which is higher than all other index IT companies put together.
Oh yes, and it's I think bigger
massive
than
achievement. Absolutely,
it's bigger than Accenture also now, which was the biggest so far. So TCS has crossed Accenture in terms of market cap as well. And I was just reading a report about the kind of growth that TCS has seen since its listing. Compounded annual growth for TCS, if you had invested in it, was 22% since 2004, while the IT index has given you a compounded annual growth of about 14%. That's the kind of outperformance.
And on a massive base.
Yes,
you know, it listed as a huge company and went on to give 22% CAGR even after that very big base. So that's a pleasant sight to see. Now 6.63 lakh crore and counting. That's the TCS market cap in rupee terms, and over $100 billion in dollar terms. I think that one is not needed. Yeah. It's 100 billion. We have splurged a bit on commas. It's a $100 billion market cap for TCS. Gagan, now, okay, a pleasant distraction while speaking with you. We were waiting for that number to hit 6.61 lakh crore, and that's what it hit. So a very celebratory moment for the Indian stock markets as well. But to come back to you, I mean, the reason why I asked you is there is always a fear in investors and regulators' mind when something grows too fast. And 34 would qualify that way, 34% loan growth. As well, just last week, the Reserve Bank Deputy Governor in charge of banks and NBFCs, NS Vishwanathan, actually cautioned banks that, you know, this herd mentality of going retail is not a good idea. So, I mean, I just want to know, would you worry that, you know, this is too fast growth, and then you had your employee being overexcited and you had to pull back? Would you worry about loan quality because of the speed of growth?
So if we look at how the entire housing market has evolved, you know, the regulator has been extremely vigilant. There are very tight loan to value caps. There are some of the other guidance notes coming on valuation. There is adequate equity which is there. Housing prices in India have been flattish. So my sense is, as long as there is a granularity and that kind of rigor in the book where the whole focus is on trying to build granularity, loss given default historically has been 2 to 3 basis points. With the kind of equity built in, the kind of equated monthly installment structuring which is done in India, where a part of the principal keeps coming back every month and thus the equity keeps building up over the 20%. My sense is the core housing portfolio will continue to perform well. And as a company, we also have a philosophy that while there is growth, we have to invest in counter-cyclical provisions. So we are carrying about 80 basis points of excess provisions off the balance sheet just to make sure that if tomorrow there is any kind of a blip, we are still being able to deliver consistent results for stakeholders. So between our provisioning policies and the granularity of the book, one is reasonable, comfortable that the last 10 years that we've done, now it's been close to about 40 quarters where we have been compounding at this pace our earnings at between 20 and 25%. I'm quite hopeful that we should be able to do it at least for the next 2 to 3 years.
Okay, Gagan, we'll leave it at that. Thank you so much for joining us. But really, the talking point right now is TCS and the way it's been moving up. It continues to move up, so almost about 2.5% gain right now. Refusing to see any stoppage there.
This is a macro trigger which is helping the sector now. There's a big move which is on, which is the money moving from banks to IT. We discussed it, Sonia. 1,000 crores of delivery buying is what we saw on Friday. It's not a small number. I mean, I don't recollect when was the last time I saw a stock with 1,000 crores of delivery buying, and initially it sort of absorbed that number for a bit and then moved on. Re-rating is on. Re-rating is on actually in the entire sector. Just pull out Mindtree's intraday chart. And one thought that after the numbers, most of it was in the price. The stock had doubled over the last 1 year. So look at that move on Mindtree.
Anuj, we should see more and more of this. We have not participated in the global growth story. The global growth story has been absolutely firing away. And now you have so many IT companies reporting double-digit growth. It is telling you the same story. It is coming at a time when the rupee is under pressure. That is a bigger tailwind for these companies in terms of their earnings. In terms of dollar earnings, of course, that will be different. But the point is, it's coming at such an opportune time. And this had to happen. the global growth story had to touch IT sector. Credit Suisse called it 2 years ago. They were probably 6 months too early. But, for 6 months, the stocks languished. And I remember Neelkan being, embarrassed every time we told him what happened to your IT call. But then the way it has fired, I mean, it was calling it right. Global growth story is firing and IT has to fire. Yeah. And TCS was telling us that they expect BFS to start firing away in a quarter or so. It would if the world economy grows the way it is.
Also, if you remember, when they were having that, when Rajesh Gopinathan was speaking to Rima, he did mention that they are moving with the times as far as digital is concerned. I mean, Digital 4.0, which is their, new program. And this is something that they've done consistently, unlike maybe Infosys, which was perhaps behind the curve a little bit. So TCS has managed to sort of evolve with the digital revolution.
Some skeptics about this whole digital thing. They say it depends on what you count as digital. Yeah. So let's not get there. The point is the number is there, double digits.
And I'll say one more thing here. As Shah Rukh Khan said in this movie, picture abhi baki hai.
Yes.
Don't count Infosys out yet. I know it's gone through its own issues over the last 3 or 4 years. But, it will make a comeback.
No, it will make a comeback because the global growth is good.
Yes.
Now, first the first rate and then the second also will move. There's no two ways about it. The rupee and the global growth story are an IT story. So that tailwind is going to lift all boats. Yeah. In a prior era, you would have expected Infosys to lead shoulder and shoulder with TCS. Now it will follow. It's only a question of 1 inch away or 10 inches away as far as growth is concerned. But this is a great moment for the IT space and for Indian IT stocks, in particular TCS, the way in which it has surged.
Okay.